Hi, everyone. I want to thank you for joining us. I have a very special treat today. Sperry from the Capital Group has agreed to come on and give us his views of active and passive management and just kind of let us pick his brain around how to think about constructing your portfolio, what type of funds to look for, that sort of thing. So, Sperry, can't thank you enough for having us on. I know I'm very excited to have you here. I really appreciate you hopping on. Before it is a content rich video here, so we're going to hop right in, but let me introduce Sperry properly. So Stephen Sperry is an investment product manager at Capital Group, home of the American funds. He has 12 years of industry experience and has been with Capital Group for 11 years. He holds a bachelor's degree in in global business financial management from Arizona State University. He also holds the Chartered Financial Analyst designation, and he is based in Los Angeles. So Sperry, hey, thank you again for joining us. Really appreciate it.
Yeah, of course. Happy to be here.
Well, like I said, I'd love to jump right in. Just have a few questions to kind of see where it goes. I know if anybody has questions about specifics after the fact, since we won't necessarily lay out specific funds or companies, they're always welcome to reach out to me, and I can go through some of that. But one of the conversations I have quite a bit today with clients is around ETFs, which of course is exchange traded funds versus mutual funds. And the broader backdrop of that conversation is active versus passive. Is it worth the cost? That sort of thing. So how do you see the relationship between active and passive moving forward in the industry and in portfolios of clients?
Yeah, I think they're going to continue to coexist as they have been. Investing is certainly not an exact science. It involves risk reward trade-offs and making decisions based on the odds of what might happen in an uncertain future. And I think just like dieting, there is no one right approach for everybody. And you can construct all kinds of portfolios either way, with active or passive. So I guess the way I see it is, if you're comparing fund versus fund, it kind of comes down to personal preference. Do you want to take the risk of doing worse than the index for the chance of doing better than the index? And better can be defined in a lot of different ways with active managers, like not just higher returns, but it could be higher income, it could be lower risk, so forth and so on. So then from there, what are the odds of success? And they are not the same in every single fund. And so this is maybe a bit of an oversimplification, but I think if a fund has been around for decades and has a long track record of consistently beating its benchmark through multiple different market environments and generations of portfolio managers, to me, I would feel like the odds of continued success over passive might be fairly high. On the other extreme, if a fund was just launched recently or has an unproven strategy or a brand new portfolio manager team that hasn't been tested yet, to me, it feels less certain whether that fund would be able to consistently beat its benchmark in the future. There's no reason necessarily to believe that it couldn't, but there's also less of a reason to believe that it could. And you'll often hear that the average active manager doesn't beat their benchmark, and statistically that is true, but the average person can't dunk a basketball either. And that doesn't mean that we assume that no one can dunk a basketball. So no one is forcing you, the investor, to pick the average active manager. So I really do believe that you can find quality active managers out there with long-term track records of success and at least tip the odds in your favor. But again, ultimately, the future is never certain. So it is up to each individual how they want to handle their investment decisions. And hopefully they do so with the help of some good advice from a professional like you.
Yeah, you bring up a great point there, because I think every time, quite a bit when we talk to clients, the idea that the average active manager can't beat its passive benchmark. That's something that even I think a novice investor has come across a few times. Why do you think it's just that, or why do you think passive investing has become so popular in the last few decades?
Yeah, that is part of it. I do think that's part of it, but you're right. I think there's more to it. So I guess I would lay out two reasons. First one being kind of what you said, right? And what I would call clever marketing, effective marketing, whatever you want to call it. A lot of these studies that show where the average active manager doesn't beat their benchmark have been fairly biased if you've actually dove into the details. So some, for example, look only at US large cap equity managers, where the success rate for active has been far lower than it has been in small caps or international equities or emerging markets or fixed income, many other asset classes. But they only look at the one that's been the least efficient or the least successful. And then sometimes they look at only higher expense ratio share classes, for example, for the active managers, which aren't really necessarily what people would invest in if they were working with a professional like you, which of course biases down the results of the active managers. And in a lot of the cases, these share classes actually have fees for professional advice built into the share class, and some of that goes to compensation for a financial advisor or an investment advisor, which is not being built into the share class of, say, a passive manager or of course the index that doesn't have any expenses. That would have to be a separate cost somewhere else if you wanted that advice, which I think is really valuable. So I think, you know, in one case you're biasing down you're basically factoring the cost of advice into the results, and in another case you're not. So I think there are a number of ways where I've seen these studies be a little bit biased in one way or another. So that's part of it. But I think the second reason, and maybe actually it's hard to quantify, but maybe the bigger one is just that the reality of investing is uncertain, right? Investing is uncertain. And one of the few things that is certain is that expenses detract from your results. And with passive investing, you usually have lower expenses. So you may not know whether active or passive will have higher returns or whether fund A or fund B will have higher returns. But you do know that passive will usually have lower costs. And so I think a lot of people just go with that. And I think also people haven't had that much success picking active funds collectively, of course. Some people I'm sure have. Because a lot of people do it in a way that is unlikely to be successful. So without going into too much detail, I think there are a lot of factors that drive investment results. Some are repeatable and some are not. But most people just look at short-term past results, like 1, 3, 5, 10 years, or maybe the Morningstar star rating, which of course is mostly based on past results. And they do so without making any attempt to determine whether those results were driven by repeatable factors or temporary factors. And that's really important to know, because you can't go back in time and buy past results unless you have a time machine. If so, your friend. So most active funds are different than their peer groups or benchmarks in one or actually usually more than one way. And markets are cyclical, meaning things go in favor for a while and then they go out of favor for a while. And so those two things can cause sometimes temporary factors to drive investment results. And so let me give you an example. Let's say you have a US equity fund that's got 40% of its assets in technology companies. And maybe its average peer, its benchmark only has, say, 20% in technology. Well, if technology companies have been doing really well, then the fund has probably also been doing really well. At least it's had a nice tailwind. But then going forward, if technology companies were to go through a rough patch, the fund may also go through a rough patch. And so I think once people have had that experience a few times of picking funds based on short-term past results, maybe short-term past results were good in part because of something that was a temporary factor, that was cyclical, right? That then became was helping the fund, and then eventually it hurt the fund once they owned it. And so they picked on short-term past results. They've seen it not work out a few times. I think eventually some people just start thinking, well, maybe I'm just not that good at finding which active managers will beat the benchmark going forward. And so I might as well just go with passive, right? And that's why I mentioned this earlier, and I talk about this all the time. It is uncertain. But I think the odds of results being driven by repeatable factors are much higher when you look at a fund that's done consistently well for long periods of time. Like if it's been around for 30 or 40 or 50 years, and you can look at all its rolling 10-year results, like January 87 to January 97, February 87 to February 97, March 87 to March 97, all the way till today, and you can see 80 or 90% success ratio versus its benchmark. you can feel pretty confident that those results were not just driven by some short-term market factor. But the future still isn't guaranteed, but I think you can tip the odds of success in your favor by focusing on long-term results when you select the fund, and then being patient when a fund is going through a patch. So I'll give you an example. One of the funds that I work closely with hit one of those really rough patches recently, trailing its benchmark by more than 5% in just over 3 months to end last year, 2021. So I went back in history and looked at all 3-month periods to see if that had happened before. And since the fund has been around since 1984, it just so happens that it has happened before, many times, 33 actually. And that's out of 450 3-month rolling period. So it's not like it's happened all the time, but it's certainly not unprecedented. Yet since its inception, it's beaten its benchmark by more than 2.5% per year on average, even with all of those rough patches in there. So the future, of course, is no guarantee. But if you were to look back at history, you'd see that short-term investment results really have been pretty unpredictable. Yet long-term results have been better than the benchmark after fees 96 or 97% of the time over all rolling 10-year periods, and actually higher if you use some of the lower cost share classes. So shareholders that have had a long-term focus have typically been well rewarded for their patience if they've stuck with the fund through its rough patches. So I guess to sum it all up, I'd say I think investors can be successful with active management, but their odds of doing so will likely be higher if they pick funds with long-term track records of success and stay patient through the rough patches. Numerous studies show that just picking based on short-term past results hasn't been an effective strategy in the past. But since that is how a lot of investors have been doing it, I do think that's a big reason why we've seen so many of them shift toward passive.
Those are great examples. There's a lot of good information in there. I think that applies to advisors too, I think, to a large degree. So I appreciate you going through that with us for sure. Wonder, do you have any, examples? I won't ask for names or specifics, but any examples of the research that you do at Capital Group or that has been done in a place like Capital Group that has generated outperformance in a fund potentially that might be helpful for clients and for viewers to see exactly how picking securities can drive excess return?
Yeah, absolutely. Depends how much time you have. I probably have 100 examples. So be careful what you wish for.
Yeah.
But, yeah, I'll try to find one good one. But I guess maybe first to level set before I get into a specific example, just for your listeners out there who maybe are not as familiar with Capital Group and how we manage money.
Yeah.
We are what's called a bottom-up investment manager. And that means that we choose companies one by one by meeting with the company's management, diving into their financial statements, and getting to know the business and industry really well so that we can form an opinion about the outlook of the business. And then from there, we determine whether we think that the current stock price is either too cheap or too expensive, depending on how we see things playing out over the next few years. So I guess broadly, that's the type of research that we do in general. And then I guess for a real life example, I'll tell you, not mentioning any company names, but I'll tell you a story of how we got started in investing in a company that we've owned for over 20 years, and has actually become one of the larger holdings in some of our international and emerging markets funds, which are the area that I focus on here at Capital Group. It's an Indian bank, but before we get into specifics of that company, let me give you a brief backstory about how we got there in general. So at Capital Group, I like to say international investing is in our DNA, because we were some of the first to invest outside the United States. We helped create what are now the MSCI indices, and we actually launched the first emerging markets fund in the industry way back in 1986. And we've actually been investing in India since the early 1990s, which is when their stock market began opening up to foreign investors. Now, one of our early investments in India was, at the time, the country's largest mortgage lender. And they had a dominant position in what was a relatively small industry at the time that we felt had a really long runway for growth, and we also thought they had some of the best managers in India. And in fact, their chairman actually was a member of the advisory board of one of our funds. Now, that year that we invested in that company, 1995, was the same year that they first set up a separate company, a bank, the company that we've been invested in for over 20 years, which was meant to help them expand beyond mortgage financing and take advantage of new opportunities in areas like commercial banking that were just being created as the Indian financial system was beginning to liberalize. So they hired top-notch people from prominent US and European banks to run it. And we eventually started investing in the bank in the late 90s and early 2000s. Now, by this time, the market, Indian financial market, was continuing to liberalize, which of course means that the government was going through a series of reforms to create a more business-friendly environment where private companies could compete for business with companies run by the government. And it was also getting easier for foreign investors like us to buy stakes in these companies. And now some of our analysts felt that the company was a bit expensive based on its near-term earnings projections, but with the potential for earnings to grow so fast for so long, and with so many big opportunities in front of them, we decided that actually on a long-term basis, it was still a buy. And so early on, and really throughout the years, while like the short-term details have changed over time, of course, there have generally been two main pieces of the investment thesis for this company, and also some of the other private Indian banks that we've owned along the way as well. First, we felt like the general banking industry in India had a lot of room to grow. And that was true in 1995, and it's still true today. And second, we felt like this company in particular was really well managed and had a lot of advantages over some of the other large state-owned banks, which would then allow them to take market share over time. So if I could sum it up, we felt like the overall market opportunity would be growing, and they'd be able to capture a larger and larger part of it over time. Fast forward to today, and this company has now been held in various capital group funds for over 20 years, as I mentioned earlier, and has been one of the best investments for some of them over the course of that time. Really, it's been a fairly large holding in some of them for the last 10 years. Now, here's the kicker. Despite the fact that it's one of the largest companies in India, most indexes, and thus index funds, even the ones that hold large Indian companies, don't hold this company at all. And the reason is that India only allows a certain amount of some companies to be held by foreign investors. And active managers like Capital Group simply own too much of this company for the passive funds to buy it in the size that they would need to relative to the other sides of the Indian companies in the index. So the index providers make a lot of their money by licensing out their indexes to passive funds to track them. And they can't, well, they have a tough time putting in companies that the passive funds wouldn't be able to buy. Because if the passive funds can't buy them, then they're not going to be able to successfully track the index. And so sometimes good companies can get excluded from the index, even if they otherwise would qualify for inclusion. That doesn't happen all the time, but there are a few examples, and it's just one more reason why in places where there are a lot of smaller, less frequently traded companies, like in small caps or emerging markets, active managers can sometimes have higher success rates over passive than they do in areas that are more well covered, like U.S. large cap equities, for example. Now, this particular company that we've been talking about, without naming it, is certainly been one of the best examples of how our active, fundamental, bottom-up research has added value to our shareholders over time. And I think that's only enhanced by the fact that it's not even held in most of the indexes.
That's a great example. I mean, on multiple levels, that's a great example. I appreciate you sharing that. I know you touched on this maybe in the second question we asked a little bit, but what about empirically? Again, I know there's a lot of examples Capital Group has had success with over time, but what about empirically? What does the broader data set show about the results of high quality active managers versus their benchmarks or passive competitors?
Yeah, I mean, I don't know how you define high quality, but
I'll let you define it.
I'd like to think Capital Group is in that category. Yeah, good. I get to define it. Okay, perfect. Yeah, so I'd like to think we're in that category, but I guess I'd put it this way. So from 2013 to 16, I was a portfolio consultant here, meaning I worked with financial advisors and registered investment advisors to help them build portfolios for their clients, both with the American funds and with funds from other companies. And in that role, I got to know funds from other fund families really well. A lot of the industry I got to know really well because I had to in order to do my job. I had to know what they were doing and how they were managing. And so, yeah, statistically, the average manager doesn't beat the benchmark in those studies. And I certainly saw a lot of them on an individual basis that had high fees, didn't have a differentiated process, simply didn't have what I would call the ingredients that lead to long-term success among active managers. However, I also saw a lot of funds that did have those things. Maybe it wasn't 50%, but it wasn't zero either, and they're not all that hard to find. For example, we manage Capital Group, we manage the American funds. And I think we are maybe the third largest fund family in the US, maybe second, maybe fourth, but regardless, we're not hard to find. And if you go down the list of our equity funds, and by the way, this is something that we publish on our website, and you can see how often each of our funds has beaten their benchmark over 1, 3, 5, 10, and 20-year rolling periods since each fund's inception. And a lot of our funds have been around for 30, 40, 50 years. One fund has been around since the 1930s. And so I don't have the numbers in front of me, but I don't think any of our equity funds are below a 50% success ratio in rolling 10-year periods. And most of them are in the 70, 80, 90% range or higher. Now, I don't know how many other active fund families publish this, but I do know that there are other high-quality active managers out there with funds that have had similar success ratios over similarly long time frames. So again, I feel like I've said this 100 times, but I want to make this, I want to hammer this home. I think it's so important. I think if you can find those active managers, the ones with multi-decade track records of consistent success, tenured managers, low expenses, some of those more repeatable factors that, Austin, I know you can help your clients find, you can do pretty well with active management, and there's no reason that you have to settle for average.
Yeah, I totally agree. I know our convictions are very similar in finding active managers and the ideal or the hopeful benefits, but to your point, the odd shifting or tipping the odds of those benefits in the client's favor. I know our convictions both lie within active managers who are doing bottoms up research. So, I mean, I just can't thank you enough for taking time to hop on with me today and talk through some of this stuff. Like I mentioned, this is a very popular topic in the industry, both with clients and with advisors, I mean, throughout. So really appreciate you making time for us and giving us some insights.
Of course. Thank you so much for having me. And, and I'll speak for myself personally, I find that the value of advice that comes from people like you is so incredibly valuable. And I think of the people I know in my own life that are not in this industry, and investments are not taught in schools, and it's something that everybody needs to do and can drastically alter the course of your life down the road. And so I thank you for doing everything that you do every day. And of course, as investment managers that primarily work through professional advisors like you, I don't exist if you, or I exist, but I flip burgers at McDonald's or something. It's people like you. So thank you so much for you're doing for our shareholders and for society. And I'm happy to come back.
It's man, I'm gonna replay this every time I'm sad, just bolster my my confidence. But no, it's mutually beneficial. So again,
how do I do on those lines that you gave me to say?
Well, thanks again, Sperry. Thank you for joining us. Appreciate your time and look forward to talking with you soon. Bye.